Welcome everyone, and thanks very much for joining us for this Market Insights event. We're very fortunate today to have three prominent, highly experienced fund managers joining us to discuss the important issues of trust and credibility, execution versus vision, and governance in the markets. The panel consists of Tim Riordan from Blackwattle Investment Partners, Ivana Gagic from Paradise Investment Management, and Marc Whittaker from Investors Mutual. The dynamic between fund managers and corporates is always evolving, and MarketMeter research aims to identify and explore the impact of those changes on the investment community perceptions around corporate performance. MarketMeter collects institutional investor sentiment data every 6 months post-reporting season. The quantitative data essentially ranks ASX-listed companies across 28 categories, from ESG to management to strategy, financials, and shareholder engagement. The qualitative data basically investigates market themes such as those that we're discussing tonight, and also provides a little color and context around why some companies score well and other companies not so well. Over 100 institutions regularly participate in MarketMeter research, and over 100 of the ASX 200 use the MarketMeter platform to gauge institutional investor sentiment on their company. MarketMeter summary reports are available on the London Stock Exchange Group's Workspace platform. Enhancing our institutional investor sentiment data, MarketMeter recently partnered with the Australian Shareholders Association and to gain retail investor sentiment on ASX companies. That research will continue moving forward and allows us to draw comparisons between retail sentiment and institutional investor sentiment, the points of divergence, convergence, and try to explore the reasons why there are differences there. We're very fortunate tonight that the panel is being moderated by Juliette Saly from ausbiz, who obviously has a wealth of experience interviewing fund managers and corporate executives to draw on. ausbiz is obviously filming the event tonight, so we thank them for that, and it'll be shown probably on Friday later this week. I'd like to thank the ASX also for joining us this evening, for their support in endorsing the event, and they'll be up shortly as well to say a few words. We're very grateful, of course, to K&L Gates for providing this wonderful venue overlooking Sydney Harbour, and for providing the delicious catering that we've got. We've partnered with K&L Gates previously, in fact, to come up with some market insights on the ESG areas that we'll probably be diving into again in the not too distant future. And I look forward to seeing Clive in particular's thoughts on the issues that arise tonight from the panel, and to see what actionable insights they might find from that. We look forward to partnering with them again in the future. And without further ado, I'll hand over to Clive, a partner with K&L Gates.
As Nick's mentioned, Clive Catcher, I'm a partner in the M&A group here at K&L Gates. Been here for 15 odd years or so. And K&L Gates is an multinational law firm with 47 offices worldwide. And so this kind of collaboration with MarketMeter and the panelists is what we're all about. So I'm looking forward to both the lively discussion and the chance to connect with all attendees. And to help introduce the event, as Nick mentioned, I'd like to highlight a few key aspects. So our focus this evening will be on the latest survey results, which shed light on the essential criteria fund managers and investors use when assessing investee performance. Now, this topic is particularly significant as it shapes the way investment decisions are made and directly influences what drives success for investee companies in a hyper-competitive market for capital. So with capital ever more mobile in the midst of geopolitical uncertainty, regulatory changes and supply chain shocks, investee companies must increasingly focus on those matters within their control. That just so happens to be the key themes of each of the three pillars of the survey. That is, how can boards and management grow and maintain trust and credibility? How can boards and management deliver and execute their stated vision and ambitions? And how can boards and management convert good governance policies into good governance actions? So from a legal perspective, these pillars are also highly relevant in investee companies and their offices, reducing the risks of misleading representations, breaching continuous disclosure obligations, and breaching statutory financial disclosures, including, as Nick mentioned, climate-related financial disclosures. They are also important to ensure that investees and officers can properly avail themselves of the critical defences to any such allegations. So from a legal perspective, they raise the question of whether management behaviour and governance execution is consistent with a defensible legal position under corporate law, disclosure obligations, and, importantly, regulatory scrutiny. So we are fortunate to have a distinguished panel featuring representatives from IML, Paradise Investment Management, and Blackwattle Investment Partners to help explore the broader commercial issues, not just the legal. And their insights will help deepen our understanding of the survey findings and offer the broader perspectives on market trends. After the panel discussion, there is an opportunity to catch up with fellow participants, and I hope everyone takes advantage to exchange ideas, build connections, and leave, hopefully, with some fresh perspectives. Before I invite the panel to come up on stage, I'd like to throw to Jessica Davenport from the ASX to say a few words. Thank you.
I'm Jessica Davenport. I'm a manager and the listings team across at the ASX. On behalf of the ASX, I'd like to thank MarketMeter for pulling this event together, to ausbiz for moderating the panel, and for K&L Gates for hosting us this evening. And thank you for the wonderful spread that you have put on as well. We are very proud to be endorsing this event as it plays an important role in strengthening the broader financial market ecosystem, bringing together investors, listed companies, and intermediaries to have an open, candid conversation about what's really driving valuations and performance today. Today's discussion, as you have heard, is centered around a simple but a powerful question: what are buy-side investors no longer willing to tolerate? With a particular focus on trust and credibility, execution versus vision, and governance, but in practice, not just on paper. These are themes that are very interesting to us because they are the themes that we are continuously hearing from companies that we engage with across the market. From our perspective at ASX, we work closely with more than 2,000 listed companies across their entire life cycle, from the IPO journey through to their life as a listed company. Our role is to support those issuers with programs designed to build visibility in the market, to strengthen investor engagement and the conversations that they are having, and to help maintain momentum post-listing, which we all know is very important. We also work closely with our policy and regulatory colleagues on initiatives that aim to simplify and modernise the frameworks that truly underpin our market. We ensure that they continually work effectively for both listed companies and investors alike. In my role, I have the privilege of speaking with boards and management teams about just that trust and credibility and the importance on delivering consistently against what they are saying to market across various things, whether it might be their financials or ESG or climate-related topics. And what the MarketMeter Insights reveal and today's conversation reinforces is just how fragile that trust can be, particularly once credibility is really called back into question. So today's environment, where markets are more concentrated and more volatile than ever, trust, transparency, and responsiveness are paramount. More broadly, strong outcomes for listed companies really rely on a well-functioning ecosystem, one where issuers are not just supported by the exchange, but they're supported by investors and institutions more broadly, all working together. Events like today support that, and they are an important part of the ecosystem, helping to bridge perspectives, which I hope we can hear from the panel and our conversation afterwards, in a really meaningful way between corporates and investors. And we are very fortunate to have a high-quality buy-side panel joining us shortly, which I am sure are going to share some fascinating insights. So I'll close with one final thought. In today's market, differentiation increasingly comes down to a few words: credibility, consistency, and execution. The companies that build long-term support and long-term resilience are those that set clear vision but deliver against it clearly and consistently and over time. So with that, I'll hand over to Juliette if you would like to begin the panel and to introduce our panelists.
Thank you, everyone. I feel like we've sort of had a good introduction there, but I will just introduce, the panel. Of course, I'm Juliette Saly from AusBiz. Then we've got Marc Whittaker from IML at the end, Giovanna Gagic from Paradise Investment Management, and Tim Riordan from Blackwattle Investment Management. So as Jessica mentioned, we're going to explore mostly what the buy side is no longer willing to tolerate. And the discussion point that Nick sort of put towards this as well is the fact that once credibility goes, it really comes back. And that's really hard, I guess, as well, to get investors to believe back into your company. So I might just start with you, Tim, and work my way down. But in your view, what's the fastest way a management team can lose investors' confidence?
Probably the fastest way, the frameworks, I think, is probably the way we try to think about it, which would be that we're really looking for alignment, accountability, conservatism, and consistency. They're kind of the broad overarching frameworks that we use to sort of really try and help us understand where, what sets apart a high quality company, which is the way we do our investing. And so it's really the inconsistencies around any of those that tend to bring things undone. And I think, the fastest ways is you're probably lurching all the way to the other end of the spectrum, which would be, outright illegality, fraud. That end of the spectrum is a really quick way to undo things.
So, Giovanna, just picking up on that, once credibility is lost, is it ever fully repairable in your view?
For us, no. I think never say never to any company on the ASX. Everyone, we love a good redemption story. For us, our process is about going and seeing companies consistently. So every 6 months, we make sure we go and see every single company within our universe. And the reason we do that is because stories change. You have a management change. Sometimes it is a cyclical reason why the stock has underperformed. And so for that reason, we do like to stay on top of companies and look for that inflection point. There could be opportunities if you do pick it at the right time and catch them on the inflections.
Because we've got a lot of investors here, so if you feel like there's a company that you can actually pinpoint to when you're discussing, feel free to bring it up. But Marc, on that, if you miss a milestone, does that matter more than potentially an earnings miss when it comes to credibility?
I think generally I think Tim mentioned it's just about consistency. So if you're under promising and over delivering, that's the old cliche. I think that's the classic MO, right, for a good management team. Let's not sell the story harder than we have to, and let's make sure we beat. Let's set expectations and make sure we beat those expectations. So whether it's earnings or milestones, or whether it's strategy, it's the market's increasingly short-term focus, right? So it's getting harder for management teams to actually establish a long-term strategy and try and build a business towards that and have the patience of the market behind them. So maybe if you're setting sort of shorter-term goals that you can demonstrate you can meet and then use that as a stepping stone to a longer-term outcome, that's probably something the market is willing to back. If you miss earnings, it's a big no-no these days. Lots of companies do it. There's lots of factors why companies beat or don't beat. But it's the pod shops and the algorithms and the electronic trading, which is really driving a lot of the pricing that we see today. So if you miss and the earnings is off by 10, you're probably down 15 to 20%, right? So it's not a lot you can do about it.
Yeah, and we were talking earlier before we came on stage about some of the algorithm trading as well, that if there is an earnings miss or a downgrade, that can continue to see a stock fall before there's a catalyst for it to recover. So I'll just sort of pick up on a similar point that you made before, Giovanna, about some of these, misses. Is there a red flag potentially that you could never recover from?
Well, if there's accounting fraud, that's probably a red flag that you can never recover from. That's a bit of a motto for us. You can't trust the accounts, and it's a bit hard when you're sitting on the outside. There is already an information barrier that we don't have as public investors.
So you're nodding there, Tim. What about how quickly management credibility can maybe get priced out when you're looking at these potential red flags as well?
Yeah, I think we'd like to acknowledge that business is hard, it's tricky, and it takes time to execute. So I think, like as Marc said, if managers are setting expectations in the right way, then we should be able to give them some bandwidth as that bumps along the journey. But having said that, if you're failing to meet expectations and you do that more than once, the chances are that the way the market structure is, it's been mentioned, the allocations to index these days, hedge funds as well, there's an absence of valuation sensitivity in that investor class. And so we think that adds a lot to the volatility that we see in the very short term as we go through these bumps along the road. And that can tend to influence quite heavily the direction of travel from a momentum perspective. And one of the other things we mentioned earlier is that it's actually, once momentum, negative or positive, is entrenched, it's actually very hard to turn it around in a different direction. You do really need another catalyst, often the company actually turning things around if it has been a negative trajectory before there's really a recognition of that. So it can be priced very, very quickly.
So do you sort of have a shopping list where you're waiting for a positive catalyst, and when you see that, that's a positive signal to buy?
Yeah, I think that'd be one of our tasks, is to try to work out, when is the right time to buy something. If we're predisposed to liking that business, it may just be a case of the right business at the wrong time, and trying to find those, the turning points is one of the things I imagine we spend a lot of our time on. And there's obviously a million factors that influence why something might be up or down on an individual day, week, or month. But over time, we tend to think that earnings are a really, really important determinant of the direction of travel from a share price perspective. And so it's often just a matter of time before, a good group of managers can begin to demonstrate that with consistency, that the market would tend to recognise that over time.
Marc, how do investors distinguish optimistic execution risk from some of these structural trust issues?
Well, I think just going to Tim's point about we're talking about management here, right, as a topic. It's all about trust, right? So if you can't trust the person you're talking to manage the company, there's no real foundation for investing in the business in the first place, right? Especially in mid caps and small caps, which is, I think, Tim and Giovanna and myself all sort of deal in. So we're not talking top 20, 30 stocks. We're talking about the next tier of companies down, with the potential for management to sort of gild the lily a little bit, or sort of be a little bit more overly optimistic, or perhaps not comply with ASX as much, Jessica, as perhaps they should. I mean, those possibilities are there, right? So you've got to be really aware of that. So if you're not trusting the person you're sitting across the table from, there's not really a lot to talk about. So I think maybe we can mention some examples of companies that might be not too sensitive, but let's say a company like Babcock, for example, where they've had successive downgrades for many periods in succession. They've had a change of management now, or a couple of changes in management. So we get to look at the story again from a new set of eyes, and try and gauge the new executive that's in charge and say, well, does he have the right background? Has he got the right motivation and alignment? Can he really make this turn this business around? Because fundamentally it should be a good franchise, but it hasn't been run well. There's been execution issues, there's been inventory issues and so forth. So the person they're putting in place now, is he the right guy to do the job? And you've got to form that view across the table. And sometimes you need to meet them 2, 3, 4, 5 times before you get enough comfort to appreciate that perhaps they are the right person for the job. And you talked about red flags. I mean, if there's a buck to be made, fund managers will be there, right? So if they think it's a turnaround, or the story is going to be something that's going to get some momentum or some interest in the market, then yeah, we'll probably look at it again, right? And it helps that there's a new set of eyes and management is backable. But if you've been in the seat or the chair for a while and you've consistently failed to deliver, I mean, your tenure is it's not almost untenable, right? So
Yeah, I'd just add to that as well. One area of the market which has seen downgrade after downgrade, and yet the market, prices in the downgrade, but then assumes that it's going to rebound quickly. It's been a feature of the market darlings, particularly across healthcare. If you look at CSL, Cochlear, they've just had years of just consistently disappointing, and yet the market, and Ramsay, I'll put them in that category as well, where the market wants to see that trough and then thinks it's just going to rebound really quickly. But in reality, that these businesses are not what they were maybe 5 to 10 years ago, and the market takes a little bit of time to actually adjust to the new norms. And so we've seen that across the healthcare sector in particular. So it's been quite fascinating.
Is there any buys in the healthcare sector anybody would be willing to put their name out and mention?
I'm talking my own book here, but we like the in the small cap healthcare space, we like Australian Clinical Labs and Integral Diagnostics. One's pathology, one's radiology. They both had a little bit of their, I mean, healthcare's been in a drawdown more generally, sort of sectors underperformed. Pathology's been a bit hard because they don't get indexation from the government, so they've got to cover their costs every year and hope that volume growth comes through. And volume growth's been a little bit checkered in terms of its consistency, but that's more outside influences. I think internally the company's been run quite well and trades very cheaply. I think it's on 10 times and a dividend yield of 6.5% fully franked. So go figure. IDX, I think, is a good example of a company where, management are really nice guys, but they just haven't delivered consistently. So that the market's focused on the operating margin. Can you deliver a margin of 20% plus in radiology? They've been hitting 18, then they'll hit a 20, then they'll go back to an 18, then they'll do a 19, then they'll do a 20, and then back to 18. It's like, guys, just set a target that you can hit it consistently and demonstrate how you're going to grow that margin over time to the sorts of levels you're talking about. But new change in management coming. There's a new CEO been appointed. He starts very shortly. So again, a chance to look at a company with perhaps a fresh set of eyes, meet the new operator and say, is this the person that can do the job?
Well, Tim, I'll follow up a little bit on that in terms of when there is a change of management. Do you think there could be a difference between losing confidence in management, maybe the management that's on the way out, and losing confidence in the overall business model?
Yes. It's sort of situation dependent, I suppose, but a couple of scenarios where that sort of come to mind as you ask that question. I think investors are generally pretty patient when it comes to giving a management team a period of time to execute a strategy, so long as that's well laid out, and that they're generally meeting the milestones along the way. And that's a really important sort of signpost. We always try to connect what we think the business can do or be longer term with where it is now and what it looks like in the medium term. And if we're comfortable there, then I think managers are generally given a reasonable amount of rope. But we're very impatient when we know that there's something new around the corner, and if the old management team are either on the way out or actually going, then the sooner that can happen and you can move on, the better. It's a well-trodden path that the gap between the old manager and the new manager is quite dangerous from an investment perspective. It's not necessarily that the trajectory of the business is changing, but the views around the management, the board table are going to change. And that presents, from an investment perspective, a reasonable amount of uncertainty and some risk around that change in direction. It often comes with a downgrade, a couple of downgrades if there's a turnaround. These things are generally not just a one-off. And so the quicker that you can get through that period, we're all there waiting for the day before the last downgrade to probably increase our positions. And so the faster that the board can get the new management team to that juncture, the better.
Have you got an example of a company that did manage to turn their credibility around quite quickly? And if so, what did they do?
Well, I was just going to say maybe Ramsay's a good example of that, where he had a long-standing CEO who was in the business for quite some time. That's also a market darling at one point, particularly for the Aussie business, and they went offshore, which is always a red flag and a bit of a no-no. And then COVID hit, and all of a sudden you went from this, fantastic Aussie business that had, great earnings growth. You had revenue growth and operating leverage come through. COVID hits, you've got inflation. It goes the other way. So you had the downgrade after downgrade, and it actually took, a new CEO, new CFO coming into the business, where you could actually see, just a fresh set of eyes and a bit of a turnaround in the story come through. So, and it took the market, a little while to get comfort, and we're not, claiming victory yet. Still a little while to go, still some hurdles to hit. But yeah, when you have that fresh set of eyes that come through, it is quite powerful, just to clear the decks, and, especially if you've been there for a long time, like the old CEO had been, you can get a bit lazy as well.
You mentioned Drone Shield. We actually prompted to go and meet the new CEO. So yeah, that was very recently. That the management changeover and their sort of willingness to meet investors, and when we haven't been inclined to meet the old group, so maybe that's a signal, I suppose, in and of itself. Another one that comes to mind would just be the path for MinRes over the course of the last sort of, say, 2 years. 2 years ago was on a really steep negative trajectory with a lot of challenge around the governance structures and the I suppose the issues that had come to fore that effectively that the founder Chris had the structures supporting him were probably inadequate. But talking to them now a year on, with a new board, a new group of people surrounding him, including a COO, who could potentially be a CEO in waiting, that type of structure has probably created a scenario where investors are much more encouraged now. And that's a relatively short period of time, I'd say, to see that turn around.
I think I can't not ask about WiseTech, given that it is, the really big story. And also, and I was telling the panel this earlier, and I'm sure many people read it today in the AFR as well, but Morningstar has basically said if Richard White is forced out, you could see a 15 to 20% drop in value. Marc, how significant when a founder is tied so intrinsically to the company is it when, and these are just allegations, bosses are behaving badly, if you will?
Yeah, well, as I think we've all sort of stated, personality or CEOs in smaller mid-caps are crucial, right? Whether it's, this isn't Telstra or BHP where the Titanic turns very slightly. A new CEO or a new chair can change the direction of a company very quickly. It's particularly in small caps. It always takes on a small cap, but when you're the founder and the business has been built around you and the market knows you as Mr. WiseTech, for example, if you're not there, there's a big question mark, right? What's going on? And often, as Giovanna said, we're outsiders looking in, which we kind of make some educated, best guesses on how the company is being run and the prospects for the business. But when the founder's not there, or the founder's in trouble, or the founder's said something and something else is actually the case, it leaves a lot of questions, right? And it talks to the quality of the business, right? Whether it's the oversight of the board, the chair, the governance function, what's not working in this business. Okay, maybe it's just a naughty boy doing naughty things, but it does ask questions about the structure of the business itself. And often founder-led businesses have started from a low position and built up over time, have the systems and the processes kept speed with the growth in the business. And often the market will see one side of the business where, as I say, we're outsiders looking in. It's been tremendous growth. This is a great story. But actually the foundations are still in need of some construction work.
Yeah, you tend to see that kind of come through when you actually go on site and go to investor days. Tim and I, coincidentally, we're just at the MinRes site over in Perth. And you can actually see the interacting with, the level under the CEO, that there is really strong bench strength. And part of that is the board's responsibility as well to make sure that for a founder-led business, you do have, that next generation coming through and there is that continuity and setting the structures in place, which MinRes have now done a really good job at ensuring that that's there.
I think that flows through rather quite nicely into the second part here, which is execution versus vision, and the discussion point here that execution can beat ambition every time. Tim, how much patience do you think the market still has for some of these long-dated strategies?
I'd say it depends. We'd probably take the view that a long-dated strategy, something that's sort of a trust me, often broadcast as a TAM opportunity, something like that, is probably fine so long as we're seeing milestones being met in the relatively shorter term. The challenge I think you get to support that type of setup is where you're not meeting those shorter term expectations. And so if there's a cycle involved, if the cycle turns negative, and maybe this compounded the MinRes journey, maybe it's compounded Richard White's story as well, with some challenges to the foundations of the growth in that business. You see a scenario where perhaps you had high expectations and then you're being met with poor outcomes, or that's a recipe for disaster. But if things are being met along the way, then investors are willing to look out to 2, 3, 5 years where there's something being promised, but you really do need to be meeting those milestones
Picking up a little bit on that, Mark, does the market then, do you think, reward certainty or opportunity?
I think both. It's an interesting tension at the moment because often you've got a good business, maybe a poor management team or a poor cycle, and so valuations for businesses, listed businesses, are quite low. And so what we're seeing at the moment is a lot of M&A emerging, right? Because the public market does misprice assets quite often, right? So if you're not delivering, whether it's management or cycle or whatever it may be, the market's quite short term, and they'll mark you down, right? You're down 20, 30% on a poor result. We're seeing M&A come through. So, we own the likes of Clearview, we own Media, we own Steadfast, and talk about naughty boys doing naughty things potentially. But and these are all businesses that had received bids in the last 3 or 4 weeks, right? Because they're underpriced for whatever reason it may be. And a long-term market participant would see the valuation in those opportunities and say, wow, these are great long-term opportunities. I can buy a stake in Steadfast today at $4, and I can see a trajectory to $6, $7 over the next 2 or 3 years. Well, we've got $6 today on the back of a corporate bid. So there's a bit of a tension there. So, public markets tend to underprice because we're more short-term, increasingly so. We're not focused on the long-term outcomes, which I think is to the detriment of the ASX and capital building in the country. But that's the way the cookie is at the moment.
Yvonne, do you think execution risk, we're talking about TAM before, but is that more the primary valuation driver compared with TAM and some of these growth narratives?
You need to meet expectations. You can have the longer term strategy, but you just need to set the path clearly. You need to make sure the earnings path for the next 3 years, that consensus is there or thereabouts, and just do what you say what you do. Like, just make sure you're hitting those milestones. So execution risk is a key valuation metric at the moment. But yeah, that's within a broad bucket.
Well, I know we're not really necessarily investing in SpaceX, but I am going to go there because, execution, ambition, you can't really put Elon Musk in any other basket other than a very ambitious human, right, Tim? So does at one point some of these very strong hopes push the payoff for an investor?
I think for sure. I mean, everyone loves to dream every now and then. We like owning the lotteries corp from the perspective that, there's probably more than half of the adults in the room would buy a ticket when there's a decent jackpot, because we love that moment of dreaming. The same goes for a visionary like Elon, and I think he's earned the right to sort of do what he's been doing and raising money. In my context, in my sort of experience set, I still remember going to one of the early presentations that Rod Drury did when Xero came to the ASX, and I don't know what the share price might have been, $5 or something like that, or the equivalent of. And it's not the same story today, but it was only a year ago it traded to $200, and I remember walking out of the meeting thinking, that story, that guy, the way he sells it is like, it's wild. If that thing works, it's going to be enormous. It'll take a long time, but it's got such a runway and an incredible proposition. And it's either the case that he's a visionary or he's absolutely mad.
Bit of both.
Well, he turned out to be visionary.
Which one's Elon?
So yeah, I think that type of scenario can be really interesting. But again, you come back to, okay, well, what's going to drive SpaceX to 100 times the current revenue? Well, there's a lot of things that are going to have to go right. And there's going to be plenty of moments that investors are going to be a little bit nervous about whether they all will. So you just probably have to tread carefully, I think.
Yeah, it's a fascinating story, and we are talking before as well about how many retail investors got through. I read that CommSec opened 30,000 international share trading accounts in the lead up. Yvonne, how much patience does the market still have for these, I guess, hopes and dreams tomorrow stories?
If you have the words AI in your presentation or any sort of kind of linkage to AI, the market is willing to pay up for it and give you the valuation for it. So hopes and dreams are there, but
the issue with having hopes and dreams story, you're generally on a high multiple, high valuation. It doesn't take a lot to slip up. And then once you do slip up, you get into that negative momentum cycle and you have no valuation support. So the drop can be a lot more significant than, and you think it will be, because, you've got to have the D rate, and then you've got to factor in the earnings, and you've got to factor in, this isn't what I thought it was going to be. And so you have this kind of multifaceted decline, if you will.
And I guess that's why compliance regulation is so important as well, Mark. So what is the disconnect potentially between what boards might reward internally and what investors are willing to reward externally?
That's a good question. Well, obviously, we're always looking for alignment, right? So I think we've all talked about consistency and I guess realism in the settings and expectations you set. For the board sets for the C. The interesting thing with board is, right, we as investors, we look at companies and we meet management formally twice a year at the half result, the full year result. We get a report card. How are you going? Your K tick, your earnings growth is 10%. That's great. Our margins are moving the right way. You've got this strategy which you're implementing. That's great. But boards get to meet management 12 times a year at every board meeting, right? And they should be holding management to account. How are you tracking along with this strategy? Are you doing what you said you told us you were going to do? How are you meeting those milestones, those KPIs? So I think the boards, in theory, are in a very good position to be able to say and set those alignments or those incentives, create those opportunities for management teams to be able to deliver and execute. So I think that's very important. For us, outside looking in, we only get that report card twice a year. So we want to meet management as often as we can, particularly if they're new. Often if you're in markets long enough, you've got really good relationships with lots of management teams because CEOs tend to do the rounds and chairs tend to do the rounds as well. So lots of the faces are very similar and you've met them many times. But again, it's really, the onus is really on the board to make sure that they've set the right alignment. And then the onus is on us as investors to say, well, do we agree with the settings that the board's put in place? Do they have enough LTIs in place? Are the STIs too generous? Are they really bringing the management team to account? Are they really holding them to account to deliver on what they say they're going to do? Is it easy to meet those KPIs? Is it too easy to meet those short-term incentives? How much accountability is in place across the executive team? Because at the end of the day, the board's job is to hire and fire the CEO, right? When you break it down to its most basic level, that's their job. They appoint the CEO. They either do the job well, they don't, and they keep their job or they don't. And that's what the board is there to do, and acting in the interest of us as shareholders.
Just going to pick up on that a little bit. How important do you think the LTIs and STIs are in terms of, making sure that someone has skin in the game and that they want to see the company, exceed its ambitions and come to fruition, Ivana?
You need to reward, the long term and the short term. You need to, if you want to hire a good person, you need to pay up for them. And so making sure that you are paying them appropriately and making sure that the actual hurdles are appropriately aligned to what you're trying to achieve. Just make sure that, you're aligning them with shareholders, but also internally with stakeholders as well.
Yeah, actually flying through this, and I do want to leave some time as well for audience questions. So I'll move on to the governance reality check, where behaviour here matters more than policy. So governance feedback increasingly centred on this observable behaviour rather than governance frameworks, policies and disclosures. Tim, what are governance issues to you that are absolute deal breakers?
Deal breakers from a governance perspective is really when we're being told one thing and something else is actually happening. So I think it's just that sort of going back to that framework is probably around inconsistency. If your alignment structures are there, then you probably, that's what we're always trying to look for is from an alignment perspective is alignment with us as shareholders. So is the board setting the incentives for a management team, does that align actually with the stated strategy? And if it does, we tend to find that there's good consistency between our expectations as investors and then the actions of the group of executives. And it's really where that breaks down. One of the earlier sort of topics and frameworks is around guidance and sort of some consistency there. And so again, if everything's in alignment, then all of those frameworks should hold. And so when that's sort of starting to break down is probably where you find those moments of challenge and I suppose some of maybe the signposts along the way. You start to see the inconsistencies perhaps are as a result of the challenge or the inconsistency with that endpoint. And if it's an unreasonable endpoint, then you get bad behaviour in between, or people give up halfway. And so you see turnover, or you see people doing things that perhaps preference short-term over long-term, that kind of behaviour.
Speaking of bad behaviour, is there sort of maybe more, Mark, a higher risk tolerance for bad behaviour perhaps in some of these founder-led businesses?
Probably. I mean, we talk about alignment, right? I mean, you don't get any more aligned than a founder developing and growing a business and bringing it to market and retaining substantial stake in that particular company. So I think there's maybe not bad behaviour so much, but more the sense that there's perhaps a more generous tolerance and understanding for a strategy to be put into place and to be executed and to be implemented, because we're probably going to give that founder the benefit of the doubt more so than an outside CEO who's just been plopped in and is on your standard LTI, STI arrangement. If you're a founder, you probably own 50, 60, 70% of the business. You are very incentivized to make that business work, to hit those numbers, to generate the results that you're setting out to achieve. So I think there's more scope to sort of miss or to make, I won't say excuses, but to have reasons why perhaps you're not travelling along the path as smoothly as you have probably led the market to believe. But, you know, as I say, small caps, it's all about the founder, it's all about the CEO. If the CEO and the founder are one and the same, and their alignments are in line with ours, we want the business to do well, we want it to hit its goals. That's what the founder wants them to, exactly looking for the same sorts of things. Then you got more of a tolerance level to give them some room to make mistakes and sort of maybe fumble along a little bit more. But if you're an outside CEO and you're just doing your job and you don't have a passion for the business, you don't have a zeal for the business, it's not your baby, then there's probably less tolerance, right? It's like, well, what are you doing? Have you got the right processes in place so you actually know what you're doing?
It may be the case with the founder that some of us as investors have been on the journey with them as well. And so you've gone from here to there and you've seen them do things in the past. And so you're willing to
you got track record, right?
Give them a bit of time to work out what the next thing is. And maybe that's that sense that they get maybe a little bit of extra forgiveness.
Yeah, when you know them and skin in the game a little bit more. Do you think there are some non-negotiable governance issues? That's hard to say, Yvonne.
Insider selling is probably one where you go, I should do a little bit more work here. And then the other one, not a non-negotiable, just that independence of the board versus the management team. You know, as is mentioned, the CEO, the board, the chair is there to fire a CEO. So if you don't have that clear line between a board and a management team, that makes it hard to do and lines get blurred. So having that independence is really, really important.
And in founder businesses, that's often an issue, right? Yeah. Who runs the business? Who runs the board? Is it the founder or is it the chair? Yeah. Sometimes they're one and the same, but yeah, that can be an issue.
Well, that's sort of my next question. Are boards doing enough to challenge some of these dominant CEOs?
I think it's a mixed track record, right? I think there's lots of instances where the CEO is calling the shots, not the chair, not the board.
Do we have any examples of some companies that we are really liking putting all of what we've discussed together? I know you talked about the Lottery Corporation, you talked about Ramsay Health. Mark, you had a couple as well, Bapcor, I think you mentioned. If you were going to give a takeaway for everyone here today, because it is a buy-side panel, Tim, what do you really like at the moment, or even themes?
Yeah, I'm happy to call a few out. There's a couple that have sort of come to mind as we were talking, and it's probably easier to talk by name when we're praising. So I guess car sales is one that car group that we've had a long-standing kind of positive view of the structures there in terms of governance and the connectivity in a really long-term sense from the founder leaving, which was a while ago now, but probably only 2 CEOs ago. So the benefit of a really long-standing board, consistent structures in terms of governance and the expectations of the way capital's deployed has meant that there's still now, probably 10 years post the founder leaving, consistency in terms of the way the business is run. And all these businesses go through cycles, and cars going through an interesting one with the sort of intersection with AI. But from a governance perspective, that's certainly been one that we've thought very, very highly of. It's also given us the opportunity to get to know some of the actual board members and to follow them across to some of their other boards It's sort of one way that we would tend to find businesses that we like. They're often run by similar people or have been run by similar people over time. And just one of the reminders from Job mentioned the trip to Perth last week and parts of WA. Probably our favourite one in that context, and it goes to some of the questions you asked about a long-dated sort of promise. One in the gold space, in the mid-cap space, is a business called Capricorn Metals. And it's run by a group of execs, including the primary, the CEO and the primary founder, who have been through 3 corporates as a group. And so we've been fortunate to follow them the whole way, because what they did in the first one is what they did in the second one is what they're now doing in the third one. And that type of consistency can be really rewarding. And in the resources context, you really are putting money in today to support something that's potentially a long way away in terms of developing a mine. Permitting the mine that they're currently trying to permit has taken 3.5 years to not yet quite make it through federal approval. So there's a lot of patience there. So you really need to trust that the people in there are ticking those milestones off as we go. But each time there's an opportunity to meet, we certainly take advantage of that. And you understand just that little bit more, peel another layer of the onion off, sort of understanding how these guys work and why it is that they're consistently able to meet guidance in a mining context. That's actually quite challenging, potentially more challenging than some other contexts. Highly volatile environment, not to mention a commodity cycle on top of it. And so that's the type of setup, the type of scenario that we're really searching for.
Excellent. 2 stocks from very different industries. Ivana?
One that we like is A2 Milk. So that's gone through a bit of a journey. Talking about positive and negative momentum in the share price. It's been a volatile ride. If the business is going through a transition, talking about trying to manage the short term and the long term, they've got this transition away from Synlait to Pocono, which is an asset they just acquired. And it's going to take some time to ramp up and, get new products out. They've just received approval for 2 new products for China label that'll go through that facility. So it's one where, they're laying the foundations and they're getting there, but they've had a few missteps along the way, some in their control, some sort of out of their control. When you meet them every 6 months, they do have these, red, orange, green type of screens, so you can track it as well. So, that's one that we like.
Like a traffic light system. I like it. Marc?
Doesn't get any more exciting than waste collection. Okay, so Cleanaway. It's a halo stock, so hard assets, low obsolescence in this AI age. It is an AI-proof industry. Everyone's got a red bin and a yellow bin and a green bin. Some councils have a blue bin. And Cleanaway will pick those up for you from the curbside, take your rubbish away, and then dispose of it in a landfill or energy from waste or some other sort of second-tier processing. So I think a business like that fundamentally isn't going away anytime soon, right? You could speculate about the classifieds or the some of the software companies, and people were wondering about the future and so on. But waste isn't going away; it's always going to need to be collected. And I think Cleanaway sold off partly on the back of the Iran crisis and the diesel costs going up and people panicking about garbage trucks never being driven again. I think that's very unlikely. So I think a business like that, where the earnings are fairly predictable and recurring, it's gone through a heavy capex cycle, so it's just coming up the other side of that. So the free cash flow performance should be very strong going forward. This is a good idea. You two should take note of it. And I think a business like that trading fundamentally very, very cheap. A good management team, a bit of a long-term strategy in place. The market's probably not giving them quite the benefit of the doubt at the moment. But a business like that, I think, for where it's trading, I find it hard to believe it's trading at these levels.
So I have one final question, and I'm just going to go Marc, Ivana, Tim, because I think I should give my mic that Nick can maybe circulate if anyone has audience questions. So my final question is, what is the buy side no longer willing to tolerate?
There's lots of things we're not willing to tolerate, but look, I think it's just transparency and being upfront with investors, right? I think particularly in small caps, where I think Tim's talked about long-term relationships with management teams can set sort of track records of delivering, and sometimes when they miss, that they find a way to sort of tell the story in a slightly different way, whether it's earnings have been adjusted for X, Y, Z. So below the line, there's lots of things that haven't been included. Yeah, or the small print will say something about these earnings are management estimates, and we've taken this out. We've capitalised this before you've expensed it. Now you're capitalising it. So your earnings look that little bit better, or you're taking something out of the OPEX line and put it in the CAPEX, and all of a sudden that's your margins look a little bit better. So I think it's just that transparency. Be consistent. When you report results, report them the same way. If you're changing the way you present your results, that's a question mark for me. And why are you doing it? And particularly if it's a management team that's been in place for quite some time, and perhaps for a particular reason they decided to change the way they present the accounts or the results. For me, that's something that I think should be a no-no, because you've got to be consistent. We've talked about consistency, and whether it's consistency in delivery or consistency in presentation or consistency in explanation, it should all be as is. Don't change the rules as you go along.
That's quite frustrating, but for us, value disruptive. I can't speak. M&A. So anything that is fully priced, reliant on synergies, a big bang, puts the balance sheet at risk. All of those hallmarks, they're generally, cause for concern and a big no-no. We've seen way too many companies do big offshore acquisitions and blow up balance sheets, and it very, very rarely works.
I think, I do agree with both of those, I guess, sentiments. But maybe to build on that, probably the last bit that I could add would be just around market structure and the awareness that companies, I think, must be building by now. The awareness that the allocation to index, the allocation to quant, the allocation to algorithmic trading, the prevalence of hedge funds, all of that, I actually don't know what that allocation, as in the overall investment allocation, is versus, say, more traditional active management. But that is larger than it was. And it's certainly coming through in the way markets trade. And so I think that the awareness of that is really important in terms of the way that capital is allocated, the consistency that companies are able to deliver. Because in the absence of that, the treatment will be incredibly harsh. And it does force behaviour from all parts of the market that you might otherwise be able to have looked through. There are stresses and pressures on all portfolios in all types of portfolios, following all different investment strategies. And so that consistency and appropriate allocation of capital, ongoing transparency, I think all of those things are a real must to support the outcomes that we're all looking for.
Excellent. Are there any audience questions? Yes, I knew I'd get one from you, Rachel.
Okay, question for the panelists. You talked about skin in the game and the importance. Retail investors really expect their directors to have skin in the game, own shares. Do you have hard conversations with companies when you see a new director or a director that's been around for multiple years that doesn't have skin in the game? So I'd love to hear your perspective.
Yeah, we definitely, as part of our annual catch-up with the board, ahead of the AGM in particular, it is always a question for us just to ask, why not? Because it is important, as we all said, incentives drive outcomes. So at every single level, that's key.
Yeah, I think the opportunity to the REM report and the opportunity to have a strike against the board when you're not happy with things, whether it's actually compensation or it's something else, it gives you a chance to really make your mark with the board, and they have to take notice, right? Because 2 strikes and they're not in a happy place. So, and if directors aren't purchasing stock or owning stock in the company, why not? I mean, that's a fundamental question, right? What is it about this business that you don't like? And you've got more insight into the business than I do. I'm owning stock. Why don't you? Yeah, it's a fair question, right?
Just a question for each of you. Looking over the last 2 years, what was the worst investment decision you made? And was it a governance issue, or was it some other factor that led that call to be wrong? It's a governance issue by the company, I should say.
Why don't you go first, Tim?
Yeah, I'll line up. It's a very recent one. So we yet to find out whether it eventually becomes a good investment or not, but it's certainly not a good one today. It's a business called Chuaz. So this is a Singaporean telco run by David Teo, the major shareholder. It's spun out of TPG before the Vodafone merger some years ago. I won't go through the whole history of the issues, but the businesses attempted to consolidate it's the number 4 and consolidate the number 3 player in Singapore to become the number 2. The regulator basically came back and said, we're not actually going to approve or otherwise the acquisition because we've found that you've been using the wrong radio frequency, and we're going to investigate that instead. And so that was a complete outside surprise, a kneecapping, as somebody put it to us. And the stock is down 60-something% off the back of that. Now, what did the company do wrong? What did we miss as investors? Well, we haven't quite worked that out. It's pretty fresh, but yeah, what did the company do wrong? And is it a case of a business that's, Teo's businesses have been famous for having a cost advantage because they've always put things together in a very lean manner. And we've, I think, as a group of investors, thought of that as the opportunity for the business. They managed to grow market share as a result of being able to offer a low cost, but a very, very high quality product. But is it actually the case that because of them operating overly leanly, have they actually missed what they could have perhaps picked up with some type of audit or something like that? So yeah, that's a really outsized surprise example. But that's probably one where you sort of look at an acquisition and you think, well, option A, you get an approval, things go where they might go, and you meet these sort of milestones to connect the short, medium, long term, where you get knocked back and we go back to where we were. Neither scenario is, a reason not to own the company in my mind, but you got option 3, which is the reason for such a substantial drawdown in the stock.
The point to make, I think, with these 2 examples and just generally is, you're always going to make mistakes, so you're always going to get something wrong. You're not going to get every stock pick right. So the aim of the game is to get more right than not, and that means sticking to your process. So if you've got a fundamental process by which you look to invest, whether it's companies with recurring earnings and some sort of predictability to their revenue and a capable management team, I mean, these are all subjective terms in a way, but if you stick to your process, so even when the markets are up or the markets are down, if you're staying true to the processes that you invest by, they should see you well through a cycle, but you're still going to get things wrong. And every time you get something wrong, there's a new lesson to take from that investment. Why did we get that one wrong? What did we miss this time? Have we taken our learnings from the last underperformer and translated it to this current investment, and it would make the same mistake? I think the long and short of it is that we're market animals, right? We're driven by the FOMO and greed and fear of missing out, and then the fear of losing everything. So a lot of what we do is about controlling those emotions and saying, well, let's be as objective about something as we can. Is this a good investment or not? Okay, they've made a mistake. Is it still a good investment? Am I overestimating my ability to assess this company as a good business? Do we sell it now and look for something else? So that's that's the questions you're always asking yourself. So it's an interactive process. You're always asking yourself those questions. I think, as I say, I think it's board in management. So for me, I've been in the markets now for close to 30 years. I think it might be even a little bit more, but I know it doesn't look it. I know, but they are. But if the chair's not doing their job, the CEO will run amok. So you need a strong chair. You need chairs that don't regulate or control or bring their CEO to account. Because if they can steal from the cookie jar, so to speak, they probably will. It's our job to be cynical and to assume everyone's lying until they prove otherwise, and demonstrate a track record that says they're not a liar. And if they're not being held to account by the board, if the chair isn't controlling the CEO or at least overseeing them the way they should, then that's the red flags you talk about. That's the ultimate red flag for me.
Thank you very much. I learned a lot. I hope everyone else did too. And thank you as well to Nick and MarketMeter. And thanks so much to our panel, of course, Marc Whittaker from IML, Ivana Gargic from Paradise Investment Management, and Tim Riordan from Blackwattle Investment Management. And I hope you all enjoyed it. It'll be on ausbiz on Friday if you want to look for the back of your head and see how great your hair's looking. But thank you so much. And thanks to K&L Gates as well.